Welcome, David, and welcome to our audiences on Twitter, YouTube, and WSJ.com. David, let's start with one of the big questions hanging over the economy and markets, which is, are we in a new world of higher interest rates and higher inflation? Or as some of the markets are beginning to price in, are we going to see quite a rapid reversal towards what we've seen over recent years coming into next year?
Well, first, thank you for having me, and I'm delighted to be here with everybody. We're definitely in an environment of higher rates. Not surprising, and you and I were talking a little bit backstage, not surprising that after a very, very extended period of very easy monetary conditions, we had a couple of very, very significant events. Pandemic, which really shut the world down for a period of time, disrupted supply chains in a very material way, and then very, very meaningful fiscal stimulus. Another black swan event in the context of the war. It's not surprising that that's led to inflation really embedded, in our economic system pretty consistently. And we're now in the process of trying to unwind that or bring that down or get it back down toward a target, because inflation is such a punitive tax on economic activity. And, naturally, you're seeing monetary policy shift relatively quickly. And so we're in a period of higher rates. Now, the market is telling you, if you look at, for example, the Treasury curve, it's inverted.
Yep.
And so the market's making an assumption that we'll reach, kind of the terminal rate here sometime soon, and the forward will bring rates back down. And certainly, if you look at most cycles historically, after some period of time, you do see a reversal. But I think we're still early in this. I think it's uncertain. And we still have a pretty strong economy, and particularly if you look at service industries and you look at how tight labor is at the moment, I think we still have a ways to go to get to the right balance. But we'll have to watch. It's uncertain, and anybody who tells you they know, they don't know.
But are you Are you concerned that markets have got ahead of themselves here on hoping for this slightly Goldilocks outcome?
Well, it's not a question of markets getting ahead of themselves. One of the things I've learned over my nearly 40 years of doing this is markets are pretty smart, but that doesn't always mean that at any moment in time that they're 100% right. Our economists certainly look for slower growth next year. They're calling for 1.9% growth globally. But they are of the view that there's a reasonable chance of having a relatively soft landing. And I would define a soft landing as we get inflation back to close to 4% inflation. Maybe we have a 5% terminal rate. We have 1% growth. That's a scenario. I think there's a reasonable possibility we could navigate a scenario like that. But I also think there's a very, very reasonable possibility that we could have a recession of some kind. And I think at this point, when I talk to most CEOs, when I'm out talking to clients, most CEOs are cautious about how they're operating their business. They're looking through the lens and saying, hey, I don't know. Certainly we're tightening economic conditions. I'd rather prepare for that more difficult environment and be a little bit more cautious right now. And of course, that creates that, negative cycle, because people slow down their planning, they hold back on some spending, they start trimming, labor. They want to be a little bit tighter, so they've got more protective room if it is a more difficult scenario.
So you talk about trimming. I mean, how much are you in anticipation of this?
Well, we are obviously very focused and correlated to the economic environment. You think about Goldman Sachs, our business is very correlated to growth in the world and global activity. And so it wouldn't surprise you that in an environment where it's slowed down very, very quickly, it has an impact on our business. And coming off an extraordinary period, we had record revenue, record earnings in 2020, 2021, then again at an even higher level. It wouldn't surprise you that the footprint grows, and most businesses are seeing this. It's a natural phenomenon that you therefore have to trim, in some areas and pull back. And so we're going through the process of thinking about, how we're going to do that. But for sure, we'll have to narrow our footprint a little bit.
And as you've signaled this, you've been trying to get people back into the office for a while. Has this encouraged people to come back in a way that maybe they weren't before?
I just say that it's, every business has to do what it thinks is right for their business. I have not had a strong point of view about how others should run their business, but I have a very strong point of view about how Goldman Sachs should run its business. And our business is a professional services human capital business where 50% of the people who work for Goldman Sachs around the world are in their 20s. And they come to Goldman Sachs to have an experience, to learn, to work in teams, to collaborate. And if that's all fragmented, that experience breaks down. And that's a hugely important part of what Goldman Sachs is, how we serve our clients, how we operate. And so we needed to create a culture of bringing people back very quickly because we thought it was hurting our competitive position as a business. And so we have nudged, cajoled, evolved. But the bottom line is we generally are operating pretty close to the way we operated before the pandemic. Certainly Monday to Thursday, we're operating pretty close to the way we were operating before the pandemic. Friday's a little different. And I would also highlight it's a U.S. issue. We have a big global footprint. We operate in 45 to 50 countries around the world. The discussion's not occurring in other countries the way it's been occurring here.
So they were coming back before the
They were coming back before this. Okay. That's the way we want to operate our business. And I think most CEOs are basically finding ways to send out messages and make choices that are appropriate for their business.
Okay. One of the other big changes in the world over the last year or so has been obviously the Ukraine war, this kind of sudden cutting off of energy supply to Europe. We've had a lot of tension with China, people trying to reshore their production and diversify away from that reliance on China. How do you see the outlook for globalization? Are we in a deglobalization period, and what does that mean?
Well, the term you use, I don't like the term deglobalization. I would come at this from a perspective that there are a variety of global forces that have been placed for a long time that are expanding and connecting economic activity around the world. Certainly, as a world, we've brought a lot of people out of poverty around the world. I think one of the issues with inflation and what's going on right now is you might have a reversal in parts of the developing world, especially when you think about energy prices and things like that. But generally speaking, we are relatively economically intertwined, globally. And in a more complex geopolitical environment, you start to see people making slightly different decisions. So I'd say the way I'd frame it is over the last few decades, we've really operated with an ethos all over the world of make it in the place where it's as inexpensive as possible and sell it in the place where you can accomplish the higher margin. And now people are rethinking with certain things, with energy, with food, with minerals, with certain healthcare needs, with microchips. People are saying, okay, I need security. I've obviously got to consider, cost and friction, but there's some things where actually cost and friction don't matter. What matters is security, access, stability. And, that in of itself is inflationary. And, that shift, I think, is a more permanent shift. But that doesn't mean we're deglobalizing. That just means that in a global economy, we're choosing much more carefully and a little bit more thoughtfully who our partners are on certain things. And I think that's only getting amplified because at the moment, the geopolitical world's gotten a little bit more complex. So
you have a business in China. What is your sense, given the current situation, when you think about deploying more capital in China?
Well, as a U.S. company who does business in China, and a lot of our business in China is dealing with global companies who are operating in China. It's not as though we're manufacturing something in China. We've been more cautious, in our plan and our outlook. And I spent a lot of time down here in Washington over the last couple of years, talking to people on the Hill, talking to people involved in the intelligence community. And I think there's a risk of kind of a more restrictive capital allocation policy coming from either side. And so if you're a capital allocator, if that's one of the things you do, you probably want to have a tighter control on your financial resources so that you have less exposure to that, given the uncertainty that exists around how this is going to operate. And so we have a more cautious approach at the moment. We're still present. We're there to serve our clients. But I think until we have more clarity as to how the policy around this is going to evolve in the coming years, we want to be more cautious. And candidly, if we were sitting here in 2019 where the dialogue around this was different, and we were talking about this, you asked me with China, I would have said something like, I think that the U.S. relationship with China, this bilateral relationship, is the most challenging thing we have to face when we think about global growth for the next decade. And it's certainly something that we think is going to be a struggle, over the coming years. So this is not something that we've gotten focused on only recently. This is something we've been focused on, for a number of years.
So you're at the moment sort of on pause, but not going fast, but not going slow.
Yeah, I'd say that one of the ways you can measure what we do in any market is, what kind of financial resources do we have allocated? we have a narrower financial footprint allocated in this environment than we might have 3-4 years ago.
So I'm going to take advantage of you on stage for something that I think people would like to hear, which is, given all of this, given where we sit at the moment, I want to do a very quick fire set of questions just around certain assets, and just give me a quick kind of, in a year's time, is this going to be up or down? Okay?
And I'm really bad at this.
I know, I'm not saying...
Just want to put that out.
I'm not saying you're going to be right.
To what I say. I am not a prognosticator.
I'm just curious, because you have a pretty interesting lens on the world. So, US stocks, in a year's time?
Lower.
Lower. Treasury yields?
Treasury yields, where on the curve?
Dollar?
Slightly stronger.
Slightly stronger. Let's go back to Treasury yields, 10-year, just for the sake of argument.
At 10 years, as opposed to giving you a number, if you listen to my view, we've got a yield curve that if we normalize, if you get that soft landing, you'll see 10-year higher. If you don't get that soft landing, you're going to see a reversal of policy, and then you could see rates the same or lower.
Okay, then soft landing, yes, no.
Can I say 35%?
No. 35% soft landing. Okay, oil?
Higher.
Residential real estate?
Lower.
Commercial real estate?
Lower.
Which is going to be worse?
Correlated. Real estate at the end of the day, I mean, it's great to snap these things out very quickly, but real estate's a financing trade at the end of the day. So if interest rates are higher, real estate by definition, the cap rate's different. It's got to be lower.
Crypto?
What about it?
Okay, let me ask a different question.
I've said this over and over again. I actually just on your publication, an op-ed just went up on the topic of blockchain. I find cryptocurrencies, Bitcoin, those things that people are speculating in, completely uninteresting, not really relevant, not in our mindset. Very, very focused on the underlying technology, the ability to innovate in financial services, to innovate with financial infrastructure. We did a bond just last week for the European Investment Bank that we settled in 90 seconds instead of the normal 3 to 5 days that it would take, taking latency out of financial markets. We have capital tied up and risk tied up. I think there's really interesting innovation that can come, and I would hope that as we move forward, the regulatory process will allow the big regulated institutions that I think have risk management capability and innovation capability and market understanding and ability to kind of participate more broadly in this innovation.
I'd like to get into that in a little bit more detail, but just quickly on crypto tokens, which obviously have been quite a big deal. I mean, do you think that Bitcoin will have meaningful value in 10 years, personally? Do you think that will still be a thing?
I don't know.
You just don't know?
I don't know, and to be honest,
You don't care?
I really, I don't want to say that. I mean, I know if I use you use those words, I didn't. So, it can't appear in the paper tomorrow that I said that. But it's just with all the things we're focused on, the value of Bitcoin is just not, it's not something that I view as really significant. It's speculative. It's a speculative thing that people are speculating in. It might be worth something. It might not. But I don't really see it having a use case, which I think is the more interesting, thing to focus on.
Okay, and are we going to see more bankruptcies come through post FTX? I mean, do you expect this to continue to ripple?
There's a whole ecosystem here, and people use the word crypto, and you can be talking about blockchain and the technology and trying to innovate around the financial infrastructure. You can be talking about stable coins and tokenization. And honestly, stable coins are really just another form of a bank deposit. I think they need a rule set around them so people really understand that. But then you can get into central bank digital currencies and you can get into cryptocurrencies, et cetera. All that falls into this big basket that we call crypto. There's a whole infrastructure of companies that are trying to innovate around all of this, and they span across that whole range. A lot of the companies will be super successful, in my opinion, particularly in areas like infrastructure innovation, in terms of the way money moves, in terms of payment rails. I think there are opportunities, in neobanks for people to do interesting things. But as you move into the infrastructure that's basically taking cryptocurrency tokens and lending against them and trying to create a financing business against those platforms, obviously a lot of the heirs come out of that, but that's a place where the business models are more uncertain, more vulnerable, tougher for me to see how they evolve, with a 5-year view.
And is there anything in that wreckage that's interesting for a company like you to go in and make better? Any of these exchanges that are interesting for a regulated business like you to try and develop?
Well, we're still, in terms of cryptocurrencies and these tokens, et cetera, we're still from a regulatory perspective excluded, from participating in a lot of this. I do think, again, I'd go back to the underlying technology, and we're spending a lot of time trying to innovate around using blockchain technology. I talked about this bond with the European Investment Bank. We're also think about bank loans. When people buy and sell bank loans, the latency in terms of how they settle, it takes 30, 60, 90, 120 days to settle a bank loan. We've been working on a digital platform that's a digital loan administrative platform that we've recently launched that gives us an opportunity to take the latency out of settling bank loans. That's a valuable tool. So I think there are lots of interesting areas for large institutions like ours to look at the technology and say, how can this technology take risk out of the market system, strengthen the market system? And that's where our focus is.
And how much are you ramping up investment in this area? I mean, how significant is it?
We've got people all over the firm that are spending time. I think it's an interesting area, and we certainly have resources devoted to it. And the scope of Goldman Sachs, I would view it as interesting and one of 30, 40 focus items where we think they're interesting opportunities. Significance, a big word in a big organization. I think it's an opportunity. We want to be able to advise clients. We want to be able to think about the direction of travel. And so we have some focus on it.
And are you seeing an opportunity right now? I mean, developers is a big part of your staff right now. I think a third or so as people.
We have about 11,000 engineers out of, mid to high 40,000.
Okay, so a bit less. But are you seeing an opportunity as tech companies lay off folks and become slightly less competitive in the labor market to pick up some talent in these sort of areas?
Well, the competition for engineering talent, as the competition for all talent, has been extremely competitive over the last few years. We've been, I think, an interesting talent acquirer of engineering talent for quite some time, and candidly, we've found super talented people off the big tech platforms that are interested in the puzzle of kind of the digitization of the financial world and the evolution of the financial world. There's been a lot of innovation and evolution around software, et cetera, but banking and the financial world has been slow because it's so highly regulated. And I actually think now you're starting to see movement and a rethinking of that in a very, very regulated industry. And so we've found some super talented, super senior engineers out of the big tech platforms over the course of the last few years that are really intrigued with the puzzle of how, moving financial data into the cloud, how we connect with our clients in the platforms that we're in, how that's all evolving. Our CIO is a gentleman named Marco Argenti who came from Amazon, was very, very involved in web services, and he's attracted a lot of super interesting people, off the tech platforms. Is the war for talent going to be a little bit less competitive in a tougher economic scenario? Probably. Yep. Is that a good opportunity for Goldman Sachs? Sure. But I think for great talent in almost any economic environment, the world's going to be a pretty competitive place.
So we've talked a little bit about Twitter today. We're not going to do too much on Twitter, but I did have a question or two, which is, you were on the right side of this deal. You advised Twitter. You got a good price for Twitter, I would say, $44 billion. You weren't left with some leveraged debt of certain descriptions on your balance sheet. What do you think Twitter's worth now?
I don't have a point of view on that. I don't know. I don't have a point of view. I'm watching the movie. I'm watching the movie with all of you, and I've got my popcorn and my soda, and I'm settling in. On a serious note, it's a super interesting platform.
Yeah.
And it'll be really interesting to see if Elon can kind of get it right, turn it into a business, and have it work in our society where there's trust with it, and it participates and function in a way that it's really embraced, and it's got a business model that can be supported and sustainable. But I'm not that close to the deal, okay. And I'm watching from the sidelines.
So what impact has the deal had on confidence in leveraged finance, and to what extent is the buyout market really open right now?
Well, the buyout market really isn't open right now because you haven't really had this rebalance of the cost of capital with the multiples that people expect for their businesses. And so the buyout market is really, relatively constrained. I don't think Twitter in itself had any real impact on the buyout market. I think the buyout market constrained very, very quickly because you had a significant repricing on multiples and you had a significant repricing in financing. And so that brought activity to a much slower level. Actually, interesting, if you go back historically, the amount of kind of leverage lending on large bank balance sheets that's underwater is at a historically low level. Yeah. And when you think about other cycles where you had a pretty aggressive cycle and then something, stopped the cycle or revalued or remarked, leverage finance broadly, the risk exposures are much, much more moderate at that point in the cycle when things shut down than they've been at other points in similar cycles.
Interesting. I've got two more questions I want to just quickly go at. One is, what's happened to due diligence? There seems to have been a lot of deals done recently where people have, texted, I'll give you another $1 billion here or there. Obviously, Elon waived due diligence on Twitter. What's changed here? Why is some of this happening? Is it just
I don't think anything's changed. I think due diligence is an incredibly important part of the process of almost anything you do, where you're going to invest, you're going to acquire, you're going to get involved, you're going to partner. I just say as an observer of markets over long periods of time, we get into periods of ebullience in markets where people are riding a momentum wave, and there are a lot of people making a lot of money on the momentum wave, and discipline and behavior, weakens. And we've seen it once, we've seen it before, we'll see it again, and occasionally that happens. And people choose to do things at a velocity or a speed or with less rigor. And generally, when people do that, sometimes people get away with it if they're doing it early enough in that momentum train, and sometimes they catch the caboose and they wind up getting left off in a bad place. But I don't fundamentally see that that's the way good professional investors operate, and I don't see that changing. There's no change there.
So final question. We've seen a few moments recently. We saw in the UK the pensions explosion or near explosion when we had this slightly abortive budget and gilt rates went through the roof. We've seen recently in commercial real estate some challenges around liquidity. Blackstone's fund has limited some of the withdrawals, etc. When you look around the financial system at the moment, where do you see the biggest risks that we should be thinking about?
Well, I think there are a couple of things. There's a significant growth in government debt, around the world, and we've also seen whether you pointed to UK gilts, but we saw it here in 2020 when we were under a little pressure, the way the Treasury market operated here, just market functioning, around government debt, and also where there's back leverage against government debt, and thinking about government debt at a time where governments have significantly increased their borrowing. I think that's something to watch and think about. There's a lot of activity, given the way the regulatory structure has evolved over the course, of the last 10, 15 years. There's a lot of activity that used to be in the regulated banking system that is now outside the regulated banking system. And there's leverage and financing against that. And, I think this activity outside the regulated banking system, I think that's something to watch, something to think about.
Are there any particular areas within that?
Well, there's a lot of direct lending. A lot of lending goes on, outside the regulated banking system. That's actually a good thing. I think it, broadens access to capital, et cetera. But, you've got to watch where people are using leverage, to drive returns and capabilities around that. And, I think that's something to watch. And so far in this contraction, this tightening of economic conditions, we really haven't seen a material move in credit spreads. And so to the degree that there was something that started to move credit spreads in a material way, then I'd be looking at lending activities, broadly, but we haven't gotten there at this point. And I don't know that we will get there. It doesn't mean we necessarily will.
And in terms of something like a liquidity mismatch, how concerned are you about something like commercial real estate, where people are in these long-term funds and they particularly want to get liquidity, and obviously you've got a double whammy of rising interest rates and people not coming back to the office, et cetera. Is that a concern, that asset class for you?
Well, I do think, and I said it before, real estate,
Sure.
Real estate's valued in the context of what it costs to finance it. And so depending if people are financed very, very long in their real estate, they can withstand all sorts of things in a cycle. If you're financed short, or you're in a place where you haven't financed your assets to match your tenants and your rent flows, then you're obviously much more vulnerable to that. I fundamentally think that prime commercial real estate in prime cities, is relatively protected. I think, third-class real estate, in most cities is going to have a very tough time, but it's having a tough time. It's going to have a tough time not because of this debate about whether people are going into workspace, et cetera. It's going to have a tough time because the expectation of what you get in world-class buildings, the continued evolution of the way services are provided, the space is made, et cetera, continues to make, older buildings, more antiquated or require much more capital, to be competitive. And, that's a trend that I think is, more long-dated rooted.
So I've taken up most of David's time, in fact, all of it. But I do want to offer one question. And we have a gentleman in the front. Can we just take one very quick question, please? Apologies for not giving more time on this. I'm sorry.
Thanks. I'll be quick. Hey, David. Sid Wilson, CEO of the Hispanic Association on Corporate Responsibility. Goldman Sachs has been such a leader in calling for diversity on companies that you're bringing public. Can you talk about what you've been seeing? Are you seeing movement there? And are you also seeing dialogue with other investment banks to hold that standard the way Goldman Sachs has?
So I appreciate the question. And as you highlighted, a handful of years ago, I guess it would be 3 years ago because it was January 2020, we made a statement that we would not take companies public in the U.S. or in Western Europe unless there was diversity in their governance. And we did that because we thought it was something that was very, very important broadly, but we also did it because we thought it would have an impact on the broader ecosystem. At that point in time, it wasn't like there were lots and lots of public companies that didn't have diverse governance, in place. There were some, though, that were going public that didn't. But the whole private equity, venture capital ecosystem was not focused on diversity and governance and was really dealing with it as a kind of afterthought at the moment of going public or at the moment becoming a more, a bigger, more visible company. And I think one of the things that's happened is there's been a lot more attention placed broadly on diversity and governance, across all businesses, whether they're private, whether they're public, large, small, et cetera. And I think that's a very healthy thing. I think we played a small role in contributing to that dialogue and accelerating that dialogue. And we've tried to contribute also by working with our clients to place, diverse clients, onto boards, both public and private. We've got a whole ecosystem that's run by a woman named Alana Wolf, where we get very, very good feedback from clients. And I think in a boardroom, having a diverse set of views, different experiences, it leads to better performance. There's lots of empirical data that shows that. And so there's still work to do on that front, but I feel like we've made a small contribution in advancing it.
Great. Thank you, David. We are out of time, but
thank you very much.
Much appreciate it. Thank you very much.
Thank you
for coming.
Thank you for coming. Nice to